What's up, YouTube? It's Joe Catchpaulia sitting on the couch making some money investing in fractional real estate online. As usual, today we're going to go through Mogul's latest listing. It is a long-term rental. They call it the Peterson. It is in Colorado Springs, Colorado. The total offering is $330,000. That's what they're trying to raise. So far, they've raised about $80,000 worth of it. So this is one that was launched at a webinar that did not sell out anywhere as quickly as the ones we saw last month. So I think that's kind of interesting to note. The average yields are much lower, right? Their average yield they're saying is 8.9%, levered IRR 10.5%, and year one yield 6.39%. All those are very low numbers, but it's because it's a long-term rental. We're not taking the business plan risk that you have with the pad splits or the short-term rentals. It's also in a market that is a very fast-growing market that tends to just not be a real strong cash flow market. In addition to that, it is it's been fully renovated in the past year, and they're putting a new roof on it. The seller's going to put a new roof on it as part of our at our purchase price, which is this $675,000. One of the things I always look for this language in their emails or in their blurbs is how the year one is projected, and their underwritten rent is below the actual in-place rents. That's always good to know, to see whether or not they're being conservative or if we think they're stretching a little bit, especially because, they did say all 4 units were fully renovated in the past year. And so when you have newly renovated units, they're often getting a slightly higher rent than they might get the next time you rent them out. That's not always the case, but it is, new is always easier to rent and for more money than even a little bit worn in. Let's see, what else did I want to say about this? Separate electric and gas meters, which are a big deal for me. I will never buy multifamily that doesn't have at least the electricity separated. It is common water and trash. Typically, those are not huge expenses and are things that we're able to bill back pro rata to tenants. Whether or not that's the case in this market, I'm not sure. Because there's a couple things that go on when you're going into different markets. Sometimes there's laws that will actually dictate what you can and can't charge back to a tenant if you don't have direct meters. So in some places, if it's not metered, you have to have depending on how it's broken up, you either have to do it purely pro rata by square footage, or there's sometimes you have to hire a third party to break it up for you. This is in some markets, it's kind of weird, and then other places it's just the fact that other landlords aren't charging for it, so you just can't charge for it. So it's kind of like what the market norms are as well. So I'm actually not sure what they did with that. I didn't dig into if any of that's being charged back or not. Okay, but let's see. So Colorado Springs, Colorado is a market. I like it a lot from a growth perspective, and it is a so it's the 40th largest city in the U.S. It's approaching about 500,000 people, which is a decent size. If you remember from other videos, I like to be in an MSA that's at least, or a city or just a market in general that's at least 100,000 people. Here we've got almost 5 times that, and you've had extremely fast growth over the past several decades. Over the last 10 years, 15%, and then just in the last 4, 3% is the estimate. Real strong growth. I looked at the county too that we're in, and it's looked even better, which is, I think, interesting. So I like that a lot. I'm going to do some of the easy stuff first. For whatever reason, I couldn't get the FEMA flood maps to open, so I'm using this flood simple map. It's using the FEMA map as its source, so hopefully this is right, but it's saying it's in an X zone. Yeah, and I'll show you just when I click on the map service center. Oh, now it's going to work. Okay, I was getting some sort of error code before, like maybe the site was down. I'm just going to put it in here because I like getting it directly from the source. There are a lot of different places where you can look at flood maps online. but I would rather just, get it from the FEMA site. And it looks like we are in the X, in the X, just like it said. I'm going to have to start. I like how this is presented a little bit better, just because it tells you, it actually says the zone that you're in. You don't have to just look at the picture, and then tells you what that zone means and when the map was published and whatnot. So I'll have to start checking and see, is it, are they always using the most up-to-date map? And I might start using this more. I don't know. I also looked at the spot crime map. It was good and bad. So the good thing is it's giving us like 7 or 8 months back of data. So it took a long time to come up with this many crimes, which I would say, okay, that's really fantastic. My only worry is this is a relatively close shooting report, but when you click into it, it actually says multiple reports of shots being fired. So it's not as if there was somebody that was shot and there's a police report for it. It's multiple people reported hearing shots fired, or maybe seeing it. It just says of shots fired. So I don't know. I don't know if there was actually a shooting here, or if people just thought that's what happened. But I think I think it's actually a pretty good looking crime map overall, considering how long of a period of time it is, and they still had to zoom out that far. I mean, the fact that we have literally nothing right here, and even though you've got like, bus stops and whatnot, which or transit, like this is an indication that it's a more populated road. Yeah, I think that's good. This is the only thing I really don't like about it, but I don't think I would let that stop me from buying this one. Let's see. Let's close those up. So what are we thinking here? I don't love how low the yields are, but when you compare them to like Arrived and Arc 7 and Real Bricks, these look pretty good for a long-term rental, especially one that's just been fully renovated. Although some of those platforms are buying just brand new homes, so we don't have that here. But this, they do show, brand new cabinets, appliances, finishes, when I, comparing the pictures to the old listings anyway. So I think we're getting a good yield compared to other places where we can buy long-term rentals. It's just, am I going to buy long-term rentals in today's market, or just wait for a time where I can get better cash-on-cash returns? And that's really what the question is. I think if I'm willing to take a lower yield for the stability of a long-term rental, then maybe this is a deal for me. If you've looked at what I've been buying over the long run, or over the last year on fractional real estate, it hasn't really been my strategy, right? Like I don't necessarily think long-term rentals are just so much more secure. I think they are than short-term rentals, but I really like the pad split model. I think even though we do have some fluctuation, it seems to be pretty stable. Although, the one thing I worry about is, that there are a lot of investors adding units to the market, and that might erode some of our return. Okay, let's see. I already talked about the market there. Oh, okay. What's the home price trend look like? Over the last year, down 1.2%. This is one of the better charts we've seen. It's not the best, but it's definitely better. So you had that spike in, you had the peak in 2022. It's come down. It really looks like it's just been basically flat since then. A lot of markets have kind of continued to decline. Although the year one forecast is down 1.7%. I'm not sure. Okay, and that says that was done in February 28th. That's interesting. So this is one of the worst down forecasts that I've seen in a while. I wonder what's making that happen. Yeah, that's a little bit worrisome, and something that I'd probably dig into a little bit more if I were going to invest in this one. As you can tell, I'm probably going to pass on it. I just don't. I don't love. I just want a better yield, and I think, especially because I have the opportunity on other platforms to buy discounted properties that are long-term rentals. I think what Mogul is really presenting in most of their deals are these, the business plans that are creating higher yields. I'm just not sure that there's enough value for me to want to buy, even though they're buying these long-term rentals in markets that I like to be in. There's just not, they don't have the delta in returns that they have against, relative to some of the other platforms, and I'm not able to buy on a discount on here. So that's where I'm kind of thinking if I was more inclined to just really lean towards the long-term rentals, I might have a different opinion of that. You can spend a little bit of time walking around like I like to do. I didn't do as much on this one as I usually do. This is kind of when I was like, I don't know if this is really core. It's not the way I would think about it. If I were an institution and I were buying multifamily, even if it was single family, or even if it were the 1 to 4 family residential multifamily, this type of property would not be, this type of neighborhood is not, what I'd call core. For a number of reasons, but relative to the rest of the Mogul platform, this is definitely a core deal. There's not a value add going on. There's not there's not some upside that we're talking about. And so it is predictable, stable income is what they're looking for. I just have to maybe have a little bit of a mindset shift to where when I'm using those terms, it's more from the institutional investing background that I have that those really came into play. And I bet I talk a lot about this, and most of you are like, who cares like what we're calling this, right? Because it's not something that you've spent a ton of time on, possibly. Okay, but so the two things I really am most concerned with is, the valuation for this, and do our rents make sense? So first, let's dig into the valuation. So we're paying $675. They're saying that that's $50,000 below what it had been originally listed for. I couldn't find the listing that showed it at that higher price, so I'm not really sure where that's coming from. It did sell last year for $460. So we're paying we're paying $215,000 over what it sold for. But they renovated all 4 units and put a new roof on. I don't know, that to me, that it seems like there's not, you can see, okay, and they say it's a gut renovation. That I think means different things to different people. Most of the investors I work with, if they call it a gut rehab, they're actually taking it down to the studs, not just to the drywall like this. But there's not necessarily a reason to do that all the time. So I think that it's obviously, completely renovated property. But what does that mean? Because we did have to negotiate for them to put a new roof on. What is the HVAC system like? I don't know. I don't know that they even mentioned that ever. And that's, I'm sure I could read in the listing and know. As I mentioned, I've sort of been spending less time on these due diligence videos than I was early on, especially if I'm not going to dig into it, just because we have so many different platforms and properties to talk about on a regular basis, and I just haven't had the time to dig into that as much. But that's one thing I'd want to know about if I were going to buy this. What is their heating and cooling system, and was that replaced when the property was renovated? I don't necessarily care so much about, a lot of people ask about hot water heaters too, or water heaters. It's already hot, or it's not already hot, right? But those are, to me, something you're replacing so often anyway, at least in my market, that I don't really care when the last time it was replaced, because it's not as big of a ticket. It's not such a big ticket item, and they don't last as long as the HVAC systems. Okay, so let's close that up. But I didn't actually show you. So it sold for that much, was completely renovated. We've got his estimate of $662. So that's pretty close to where we're at, right? We have it under contract for $675. And the fact that they're going to put a new roof on, that creates some value for us, but not in the way, it's not something that truly does in that way. So I'm not sure. I feel like I don't know. Sorry, you can tell I'm pretty tired today and not putting the best sentences together. I apologize. I'm gonna just get through this pretty quickly, and then hopefully, some of you guys in the comments and in the Discord will chime in with some additional due diligence. I know some people have been talking about it in there already. Before I forget, please like and subscribe. In the description of this video, I have links to all the places where I'm currently investing in fractional real estate online. Please do your own due diligence on all of those links and platforms. Some of them are offering some money if you sign up. Some of them are referral or affiliate links that if you meet certain criteria, they might give me bonus shares or send me money as well. But I'm not recommending that you use them just because I am, right? You want to dig into them, do your own due diligence, make sure they make sense. Some of these platforms are pretty terrible, and you have to work hard to get a good return. Some of them are okay, and some of them I put some money on, but I probably won't put more. I just did it to take advantage of the free shares when I first bought, something like that. Also in the description of this video, I have a link to the Discord channel I set up. This is over 250 of us have joined. We are just talking about all different platforms, sharing info on properties, on platforms, on strategies, due diligence, and that's what I was just mentioning. So if you have other insights into this property, this market, I'd love it if you could share that. So please just jump in the Discord and do that if you're so inclined. And if you've been lurking in there for a while, because I know we have a lot of lurkers, feel free to jump in whenever you have some insights to share or questions that nobody's answering. Okay, so this estimate anyway is close enough that I feel like, okay, we're not really overpaying, because prices are always, they're not a perfect science, right? So that's not too bad. And the Zestimate range, we're well within the range of the Zestimate. On Realtor, though, their estimated value is $438,000. I don't know how we're so much worse, but you can see before that sale, they were up here in the high fives, and then it dropped down significantly. And I think this happened. Well, actually, that was just January of this year. So I don't have any idea where that's coming from. That's seems pretty far off. Where they bought this for $460,000 a year ago and then did a complete renovation, it's hard to believe that the 438 is accurate. And then Redfin, they gave us a pretty wide range again. At least the top of their range is above what we're paying, so that's always good. And then, their actual estimate, though, is $593. Now, one of the things, none of these sites know how, what level of renovation these have had. They're taking comps from other sales. And so I would guess that on average, the properties that are selling in this market are not a fully renovated property. So you would expect to be closer to the higher end of the range. So it doesn't seem to me that we have a big basis problem on this one. Especially where the estimate's so close. I thought that was kind of interesting. But anyway, and then as far as, the rental rate, well, we know already that they're underwriting below the in-place income. And so let's see, what do we have there? Oh, yep, got my little calculator going. 69360 divided by 4 divided by 12. So $1,444 a month is their average rental rate. The Zestimate for these, the rent Zestimate is way below that, right? $1,099. So that's not good at all. That may reflect that many of the units in this area, again, are just not renovated units. But $350 difference is pretty big. But when I looked at the average rental in the market for 2-bedroom units that are apartments and condos, and this is using Zillow, market rental, average rent is $1,626, which is, makes me think that our $1,444 makes a lot more sense. And then I used Rentometer as well. Again, just using 2-bedroom apartment rentals in that area. And you can see there's a whole bunch of these, right? But you can also see, okay, all the lower ones, or almost all of the lower ones, are in our area, right? This is our unit. So most of the ones that are showing up that are lower are here. I think I don't have a current account with them. I haven't used this site in quite a while, but you can see, so all the more expensive ones are over here. We're definitely on the lower end. And when you look at, what's green? That's actually 926 to 1264. But then you see like two or a couple of the blue ones right in there. And it makes me wonder, are these ones that they pulled in, are those actually from this property, right? Did it just get above market rents on a couple of units because they were really nice, fresh renovations, and we're not going to expect that in the future? I don't know the answer to that question. And I also don't know exactly what these units rented for. Sometimes when you search the address, you can find the old rental listings. I didn't see them. I didn't spend a ton of time looking, but it's something that you could do too if you wanted to be a little bit more sure on the income side. I feel pretty good about it because the in-place income is already there. I wish when they said, hey, we're underwriting below in-place income or actuals, it'd be great if they shared what those actuals were, right? Are they like $2 below, or are they 10% below? Like it's a significant difference, right? Or it could be. Let's also just shut off the refinance and see how much that hurts us. 8.9, 9.7 gets us into single digits for IRR. Let's turn that refinance back on, right? Because we were 8.9. Okay, so it didn't change our yield at all, and changed our IRR just a little bit. I mean, almost a whole percent actually, but got us into single digits. So for me, I don't find this one particularly exciting. One of the reasons that I've been a real estate investor over the last 25 years or 20 years, 21, I don't know, losing track. But anyway, the reason I've been a real estate investor that long is I believe I can get better returns than what I'm going to get in the stock market or in a lot of different places where your average returns are high single digits, 10%, somewhere around there. Over my investing career, I've done significantly better than that with real estate, with a lot of different business models. And I believe in fractional real estate investing, we can as well, and do it in a way that is, we're still getting a good risk-adjusted return. Like, I think, yes, you can look at this. It's a long-term rental. Is it a lower risk? Probably so, right? I mean, I think that it's definitely lower variance, right? Like, it's lower the amount of the amount that your income fluctuates is much lower. But is there less risk, less downside risk of rents going down, some shock to the economy hurting this area? That's what I'm not completely sure about, especially once we start to have a really diversified group of properties. Now, I do think it's less than the short-term rentals. I mean, we're seeing that right now across Mogul's. Most of their short-term rental deals are performing poorly, at least all the ones that I own, and then several others that I'm aware of. But over the hold period, are they going to do worse, right? Like, we might have some years that they are amazing, and so overall, they end up, better overall. And then, does that fluctuation really mean that they were riskier? I mean, that's one of the things that I think sometimes we look at a very stable return and think that there's less risk in that return, and I don't necessarily think those two things are exactly the same, right? Because the risk is, okay, what happens if that, what are the possible outcomes where that stability goes away, right? Where that income stream disappears, versus just, okay, it went up and down over the whole period. So I don't know, and I think that there's, on the flip side too, is with the pad split model and with the short-term rental model, during certain times, I think there's the possibility to outperform, as well. So I don't know. I guess all that being said, I'm just not excited about 8.9% average yield, 6.39% year one yield. To want to take on, to want to buy a deal, even though the Mogul platform is one that I'm happy to be investing on. We're also still getting that. We have the platform risk. It's just hard for me to want to do that for those types of returns when, maybe if I were someone who was looking for that level of return, I'd be an index fund investor, right, or something like that. But I just believe, like, with proper picking and lots of different things going right, that we should be able to do better than that. So I don't know. That's my thoughts on that. You can tell I was super tired today. Sorry about that, guys. I'm curious. Are you buying this one? If so, why? Is that, are you perfectly happy with a 6% yield, 6.5% yield? Hopefully going up over the whole period. Are you expecting better? One of the things that I was kind of surprised at, okay, they're saying 3.5% appreciation, and we're still only getting, a 10% IRR. Even though these are levered deals, right? What is our leverage? What percent LTV? I mean, it's 75% LTV, 3.5%. Yeah, I don't know. I just think the 10% IRR is just not exciting to me, and I guess I've said that way too many times. So let me know what you think. Until next time, I'm just going to keep making mistakes so that you don't have to.